Navigating the ripple effects of inflation on personal finances. Inflation, at its core, is the rate at which the general level of prices for goods and services is rising, subsequently eroding purchasing power. It's measured through indices such as the Consumer Price Index, CPI, offering insights into economic health. Understanding inflation is crucial for maintaining financial health, as it affects everything from the cost of living to investment returns, guiding individuals in making informed financial decisions. Historical instances of inflation, like the hyperinflation in Weimar Germany or the more recent Zimbabwean inflation crisis, serve as stark reminders of its potential devastation. These periods highlight the importance of sound monetary policy and financial planning. By studying these examples, individuals and policymakers can glean valuable lessons on preventing future economic turmoil. The causes of inflation are multifaceted, involving complex dynamics between supply and demand, government monetary policy, and global economic factors. An increase in money supply or demand outstripping supply can trigger inflation. Additionally, government policies, such as altering interest rates, play a significant role in managing inflationary pressures, underscoring the importance of strategic economic planning. Inflation manifests in several types, including cost-push inflation, where rising costs of production push prices up, and demand-pull inflation, resulting from demand outpacing supply. Built-in inflation, which spirals from the expectation of future inflation, further complicates the economic landscape. Recognizing these types helps in formulating targeted strategies to combat inflationary effects. The relationship between inflation and currency value is inversely proportional. As inflation rises, currency purchasing power falls. This dynamic has significant implications for foreign exchange rates, impacting international trade and investment. Understanding this relationship is vital for investors and businesses operating in the global market, ensuring they can navigate the complexities of inflation and preserve their financial health. Understanding the intricate dance between inflation and interest rates is crucial for anyone looking to safeguard their financial future. Central banks globally use interest rates as a lever to control inflation, aiming to strike a balance that fosters economic stability. When inflation rises, increasing interest rates can help temper this by making borrowing more expensive, thus slowing down spending and investment. Conversely, in times of low inflation, reducing interest rates can stimulate borrowing and spending, propelling economic activity. This delicate balancing act directly impacts savings and loans, influencing both the return on savings accounts and the cost of borrowing money. The relentless force of inflation can quietly erode the value of savings over time, a phenomenon that often catches savers off guard. As the cost of goods and services increases, the purchasing power of money stashed away diminishes. To combat this, savvy savers look towards financial strategies and products that offer returns above the rate of inflation. This proactive approach ensures that their savings not only retain their value but potentially grow, despite the inflationary pressures that loom over time. When it comes to investments, inflation can be a double-edged sword. On one hand, certain assets like real estate and stocks may appreciate in value, offering protection against inflation. On the other, fixed income investments might lose their luster as their purchasing power gets diluted over time. Investors, therefore, must navigate these waters with a keen eye, diversifying their portfolios and considering assets that historically have fared well against the backdrop of rising prices. This strategic allocation of resources can help shield their investments from the eroding effects of inflation. Real estate often emerges as a beacon of hope amidst the inflationary gloom. As prices for goods and services climb, so too can the value of property and rental income, providing a hedge against inflation. However, this sector is not without its risks, as interest rates and market dynamics can greatly influence real estate values. Investors looking to dive into this space must do so with diligence, keeping an eye on market trends and being prepared to adjust their strategies in response to inflationary pressures. Inflation's impact on retirement planning cannot be overstated. With the cost of living expected to rise over time, retirement savings that seem sufficient today may fall short in the future. This necessitates adjustments to retirement strategies, incorporating investments that are expected to outpace inflation and grow over the long term. By planning with inflation in mind, individuals can work towards ensuring that their golden years are as comfortable and financially secure as they envision. Understanding the wage price spiral is crucial during inflationary periods. This phenomenon occurs when rising wages lead to increased spending power, pushing demand and prices up further, which then demands higher wages again. Navigating this cycle requires strategic wage negotiations to maintain purchasing power without exacerbating inflation. Inflation significantly impacts household budgets, affecting daily living costs from groceries to utility bills. Households must adopt savvy financial strategies, such as tracking spending more closely and prioritizing essential expenses. Adjusting to a budget that accounts for inflationary pressures is key to maintaining a stable financial footing. To inflation-proof your financial plan, incorporating diverse investment options and hedging strategies is essential. Diversification across asset classes can mitigate the risks associated with inflation, while investing in inflation-resistant assets can protect your purchasing power. Regularly reviewing and adjusting your financial plan helps ensure resilience against inflation. Treasury inflation-protected securities, TIPS, offer a reliable way to hedge against inflation for those concerned about their purchasing power. By adjusting the principal in line with inflation rates, TIPS provide a safeguard for investors, ensuring that their investment maintains its real value over time. Comparing inflation rates across different countries reveals the global nature of inflation and its varying impacts. This comparison can influence international trade decisions and investment strategies. For businesses and investors, understanding global inflation patterns is crucial for making informed decisions in an interconnected economic landscape. Understanding the connection between inflation and taxes is crucial for effective financial planning. Inflation can silently adjust tax brackets and deductions, often leading to bracket creep, where individuals are pushed into higher tax brackets without a real increase in purchasing power. Strategic tax planning, therefore, becomes essential in an inflationary environment to optimize tax liabilities and ensure more of your income is preserved for future needs. The psychological effects of inflation on spending habits cannot be underestimated. Inflation expectations can lead to changes in consumer behavior, prompting people to spend or save differently. This shift is often driven by the anticipation of higher prices in the future, leading to increased current spending. Coping strategies, including budget adjustments and financial counseling, can help individuals manage the stress associated with these changes, ensuring a balanced approach to personal finance during turbulent economic times. Businesses, too, face their own set of challenges when adapting to inflation. Companies must navigate the delicate balance of adjusting prices without alienating customers. Innovative pricing strategies and cost management become pivotal in maintaining profitability. Beyond pricing, businesses must also consider the inflationary impact on wages, supply costs, and overall operational efficiency to stay competitive in an evolving economic landscape. Predicting future inflation trends is a complex but vital aspect of financial planning. Factors such as monetary policy, global economic conditions, and technological advancements play significant roles in shaping inflationary expectations. Understanding these elements can aid in forecasting future inflation trends, allowing individuals and businesses to make informed decisions. The role of technology, particularly in data analysis and economic modeling, has become increasingly important in predicting these economic shifts. In conclusion, staying financially secure in an inflationary world requires a multifaceted approach. From understanding the impact of inflation on taxes and spending habits to adapting business strategies and forecasting future trends, the key lies in staying informed and proactive. By embracing a comprehensive financial planning strategy that includes diversification and hedging against inflation, individuals and businesses can navigate the challenges posed by inflation, ensuring long-term financial stability and growth. Since there are no topics provided for outlines number 21 to 25, I will create content based on a continuation of the inflation theme, focusing on potential topics that follow logically from the previous outline. In the face of rising inflation, it's essential to understand the role of cryptocurrencies and blockchain technology. As digital currencies become more mainstream, their potential to serve as inflation hedges grows. The decentralized nature of cryptocurrencies means they aren't directly tied to the economic policies of any single country, making them an attractive option for those looking to diversify their portfolios against inflationary pressures. However, the volatility of these digital assets must be carefully managed. Another critical aspect of navigating an inflationary environment is the importance of financial literacy. In times of economic uncertainty, understanding the basics of personal finance, from budgeting to investing, becomes even more crucial. Financial education can empower individuals to make informed decisions, helping them to safeguard their wealth against the eroding effects of inflation. By prioritizing financial literacy, individuals can better prepare themselves for the challenges of an inflation-prone economy. Sustainable investing has also emerged as a significant consideration in the context of inflation. As more investors seek not only financial returns but also positive environmental and social impacts, sustainable investments can offer resilience against inflation. These investments often focus on renewable resources and technologies that are less susceptible to the fluctuations of traditional markets, providing a buffer against economic downturns and inflationary periods. The growing interest in sustainability suggests a shift in how we think about investing in an inflationary world. The role of government fiscal policy in managing inflation cannot be understated. Through tools like taxation and government spending, policymakers can influence economic activity and, by extension, inflation. An effective fiscal policy can help stabilize an economy, reducing the severity of inflation spikes and protecting citizens' purchasing power. However, the balance between stimulating economic growth and preventing inflation requires careful navigation to avoid unintended consequences. Lastly, consumer behavior plays a pivotal role in the inflationary cycle. The psychology of spending and saving during inflationary times can significantly impact the economy. When consumers anticipate higher inflation, they may increase their spending, further fueling inflation. On the other hand, if consumers cut back on spending due to inflation fears, this can lead to economic slowdowns. Understanding and anticipating consumer behavior is crucial for both businesses and policymakers in managing the impacts of inflation. Inflation profoundly affects tax brackets and deductions, subtly shifting financial landscapes. As prices rise, nominal incomes may creep into higher tax brackets, a phenomenon known as bracket creep, inadvertently increasing tax burdens. Savvy taxpayers navigate this by employing strategic tax planning, adjusting deductions, and leveraging tax-advantaged accounts. Understanding these dynamics is crucial for minimizing the inflationary impact on one's taxable income. The psychological effects of inflation extend beyond the wallet, influencing consumer behavior significantly. Anticipations of rising prices can lead to preemptive spending, further fueling inflation in a self-fulfilling prophecy. This cycle affects spending habits, with consumers either rushing to purchase before prices climb or tightening belts in fear of future hikes. Coping with these stresses requires a balanced approach to spending and saving, emphasizing financial well-being. Businesses face unique challenges during periods of inflation, necessitating adaptive strategies to mitigate adverse effects. Pricing strategies become paramount, as companies must balance between covering increased costs and remaining competitive. Innovations in supply chain management and efficiency can help businesses absorb and adapt to these economic shifts, maintaining profitability without alienating customers. The future of inflation remains a topic of intense speculation and analysis. Factors such as geopolitical events, supply chain disruptions, and monetary policies play critical roles in shaping inflationary trends. Advances in technology offer promising tools for forecasting, enabling economists and policymakers to anticipate changes more accurately. Staying ahead of these trends is essential for both individuals and businesses aiming to navigate the uncertain waters of future inflation. In an inflationary world, staying financially secure requires vigilance, knowledge, and adaptability. The key takeaways emphasize the importance of understanding inflation's multifaceted impact, from daily costs to long-term savings and investments. By staying informed and employing diverse financial strategies, individuals can safeguard their financial health against the erosive effects of inflation. Encouragement to remain proactive in financial planning resonates as a beacon of hope amidst economic uncertainties. Understanding the psychological effects of inflation on spending habits is crucial in today's economy. The anticipation of rising prices can lead consumers to spend more preemptively, which, paradoxically, can further fuel inflation. It's a cycle where expectations drive behavior, emphasizing the need for strategic financial planning to navigate through these uncertain times effectively. Businesses, too, are deeply impacted by inflation and must adapt swiftly to remain competitive. Strategies such as adjusting pricing, streamlining operations, and exploring cost-effective supply chains become paramount. By staying agile, companies can mitigate the negative effects of inflation, ensuring their longevity and sustained customer value. Looking ahead, predicting future inflation trends requires a multifaceted approach. Factors like global economic policies, technological advancements, and supply-demand dynamics play significant roles. The ability to accurately forecast inflation involves understanding these complex relationships, aiding in more informed decision-making for both individuals and businesses. In the realm of technology, its role in forecasting inflation is becoming increasingly prominent. Advanced analytics and predictive modeling offer insights that were previously unattainable, presenting new opportunities for preemptive strategies against inflationary pressures. This technological edge is reshaping how we approach economic forecasting and financial planning. Concluding, staying financially secure in an inflationary world demands vigilance, informed decision-making, and adaptability. By understanding inflation's impacts and employing strategic financial planning, individuals and businesses can navigate the challenges it presents. Staying informed and proactive is key to maintaining financial health in an ever-changing economic landscape. Inflation's impact on tax brackets and deductions is a critical aspect to consider for effective tax planning. As inflation rises, individuals may find themselves pushed into higher tax brackets without an actual increase in their purchasing power. This phenomenon, known as bracket creep, can lead to a higher tax liability. Therefore, understanding how inflation affects these elements is essential for developing strategies that can mitigate its impact, ensuring that individuals can protect their real income from being eroded by inflation. Strategies for tax planning in an inflationary environment involve being vigilant about tax code changes and exploring opportunities for tax-efficient investments. It's crucial to adjust financial plans regularly to align with the current tax implications of inflation. Utilizing tax-advantaged accounts and investments can also play a significant role in preserving purchasing power and minimizing the inflationary impact on personal finances. By staying informed and proactive, individuals can navigate the complexities of taxation in high inflation periods more effectively. The psychological effects of inflation on spending habits are profound, influencing consumer confidence and financial decision-making. Anticipation of rising prices often leads individuals to spend more today to avoid higher costs tomorrow, fueling a cycle of increased consumption and inflation. This behavior underscores the importance of understanding the psychological impacts of inflation, as it can lead to suboptimal financial decisions. Developing coping strategies to manage these tendencies can help individuals maintain a balanced approach to spending and saving, even in uncertain economic times. Businesses face the challenge of adapting to inflation by reassessing their pricing strategies and cost management. Inflation can erode profit margins and disrupt pricing models, compelling businesses to find innovative solutions to maintain competitiveness. Implementing flexible pricing strategies that reflect current market conditions and input costs can help businesses mitigate the adverse effects of inflation. Additionally, focusing on efficiency and productivity improvements can offset some of the inflationary pressures, enabling businesses to navigate through periods of high inflation more successfully. Predicting future inflation trends requires analyzing various factors, including monetary policy, global economic conditions, and technological advancements. Technology plays a significant role in forecasting inflation, offering tools for better analyzing data and identifying potential inflationary pressures early. As we look towards the future, understanding these influences can provide valuable insights for individuals and businesses alike, helping them to prepare and adapt their financial strategies to maintain stability in an ever-changing economic landscape. Keeping an eye on emerging trends and being adaptable can make all the difference in staying financially secure in an inflationary world. Inflation, a term that often sends shivers down the spine of any financially conscious individual, refers to the general rise in prices of goods and services over time. Understanding inflation is crucial for maintaining financial health, as it directly impacts the purchasing power of money. By measuring inflation through various indices, individuals and policymakers can gauge the economic temperature, allowing for informed decisions to safeguard financial stability. This foundational knowledge is essential for personal financial planning and for navigating the complexities of the economy. Historically, significant periods of inflation have left indelible marks on economies worldwide, from the hyperinflation in the Weimar Republic to more recent examples like Zimbabwe in the early 2000s. Each instance offers valuable lessons, highlighting the importance of monetary stability and the potential consequences of unchecked inflation. These historical precedents serve as cautionary tales, emphasizing the need for vigilance and adaptive financial strategies to mitigate the risks associated with inflationary pressures. The causes of inflation are multifaceted, involving complex interplays between supply and demand dynamics, government monetary policies, and global economic factors. Supply and demand imbalances can lead to price increases, while government monetary policy, particularly the manipulation of interest rates and money supply, plays a pivotal role in controlling or exacerbating inflation. Furthermore, global economic factors, such as oil price shocks or international trade dynamics, can also significantly influence domestic inflation rates, underscoring the interconnected nature of modern economies. Inflation manifests in various forms, each with distinct drivers and implications. Cost-push inflation arises when production costs increase, leading to higher prices for consumers. Demand-pull inflation, on the other hand, occurs when demand outstrips supply, pushing prices up. Built-in inflation, fueled by the expectation of future inflation, perpetuates a cycle of price and wage increases. Understanding these types allows for targeted strategies to combat inflationary effects, ensuring a more stable economic environment. The relationship between inflation and currency value is a critical aspect of economic theory and practice. As inflation erodes the purchasing power of a currency, it also affects its value in foreign exchange markets. This dynamic can have far-reaching implications for international trade and investment, as well as for individual financial decisions related to savings, loans, and currency exchange. Recognizing and responding to these impacts is essential for maintaining financial stability in an inflationary context. In the ever-evolving economic landscape, understanding the psychological effects of inflation on spending habits is crucial. The anticipation of rising prices can lead consumers to alter their purchasing behavior, often accelerating spending to preempt cost increases. This preemptive action, however, can further fuel inflation, creating a self-perpetuating cycle. Businesses and individuals alike must navigate these psychological undercurrents to make informed financial decisions, underscoring the importance of psychological resilience in economic planning. Adapting to inflationary pressures poses a significant challenge for businesses. To mitigate the adverse effects, companies can adopt various strategies, including adjusting their pricing models to reflect rising costs without alienating customers. Additionally, exploring cost-effective supply chains and improving operational efficiencies can help buffer against the financial strain caused by inflation. By staying agile and responsive to market changes, businesses can sustain growth even in fluctuating economic climates. Predicting future inflation trends is akin to navigating a complex web of global and local economic indicators. Factors such as geopolitical events, technological advancements, and shifts in consumer behavior all play pivotal roles. The advent of sophisticated forecasting tools powered by artificial intelligence offers new insights, enabling more accurate predictions. However, the inherent unpredictability of economic dynamics means that forecasts must be approached with caution, serving as guides rather than absolutes.